let's welcome on board Sanjeev Prasad. He's the MD and co-head of Kotak Institutional Equities as well. Sanjeev, hi, good morning. Thank you so much for making time and speaking with us. What do you make of the earnings season so far? Has started on a bit of a muted note. Do you think that will call for a derating for the EPS estimates for the full year for Nifty?
Well, not that many companies reported. So if you look at the banking names among the larger sectors, some of them reported. Numbers are pretty decent over there, mostly in line with expectations. So no real negative surprise over there. IT sector, another big sector, which some of the companies reported fairly disappointing sort of numbers for now. The analyst community has already made one round of earning downgrades, I assume. The next round, or if any, will depend on what happens to the US economy, the pace of slowdown, and so on and so forth. I assume you could be possibly seeing some more downgrades over there. Reliance's numbers were pretty decent, especially at the bottom line levels, given the one-off tax benefit. So broadly, so far, so good, I would assume. Now, if you look at the sectors which are still to report, among the larger ones, auto is an important one because on an incremental basis, that's driving the net profits of our coverage, as also the Nifty 50 index quite significantly. And then you'll have to wait and see how some of the other larger companies report, especially on the consumer side. And consumption demand is obviously not looking that great at this point in time. So you'll have to wait and see the guidance for consumption companies before taking any call on the consumer discretionary space in particular. So as of now, we have cut numbers somewhat compared to, let's say, a month back. Our earning numbers are down about 1% or so for FY24. Most of that is coming from the IT sector.
Right. One is about numbers cut. One is about what the market was factoring in. Do you think that the correction that we saw in Feb and March largely factors in the decline or a slowdown?
Don't think so, especially if you look at the valuations of most of the consumption or the outsourcing names. Still on the higher side if I compare valuation with, let's say, March 19, which is a good reference point because the policy rate was exactly the same as what it is currently, 6.5%. Bond yields not too different from where we are currently. Look at most of the growth stories, either in the consumption space or outsourcing space, multiples are still somewhat higher compared to that's March 19 of pre-COVID levels. So it doesn't look like as of now we are seeing some of the negative risk being priced in fully. And I would be especially worried on the consumer distribution side where demand conditions look very, very muted for now. And I would assume you will see a fair amount of earning downgrades over there. And along with that, could possibly see some amount of multiple derating also. I mean, look at what has happened in the IT sector in the last 12 months. Multiples have corrected significantly. Plus, we have seen some amount of earning downgrades. So, the overall impact has been pretty significant as far as stock prices are concerned.
Okay, meantime, just wanted to get in your take then, Sanjeev, as to what the outlook is when it comes to new age tech companies. Do you have any thoughts? Would one need to be very selective when it comes to this place, or is it a clear no, given the fact that now we are seeing signs of the companies taking cognizance of their profitability, their financial metrics, and clearly appealing to what investors on the street want to hear? Are you selective within this space?
Yeah, see, each company has a very different business model, very different space it operates in, very different market structure, competitive dynamics, and so on and so forth. So you obviously have to take a bottom-up view. I mean, this is true for just about every stock, actually. There's nothing like looking at stock on a top-down basis anyway, based on some sector call. So yeah, and this especially like it's much truer, I guess, for the new tech companies where profitability is still a question mark in many cases. The path to profit is still not very clear, even though many companies are now starting to focus on cost management and profits. But still a long way to go from where we are. And in some cases, we are starting to see competitive dynamics starting to weaken actually. And it's coming a time when, as I was saying earlier, consumer discretionary demand is not looking that great. So all put together, even though the longer term prospects of most of this company look good, I would still be a bit careful in the shorter term.
Sanjeev, what's the view on pharma?
See, again, it's a sector we have to look at things on a very, bottom-up basis, because there's nothing like, a sectoral call as far as pharma is concerned. So we are reasonably positive on most of the names, especially the domestic pharma part of the story, where most companies seem to be doing quite okay, 10-12% top line growth, at least for the next several years. So likely no issues as far as competitive dynamics, etc. is concerned. So no real challenge over there. On the US generic space, the problem is, every few weeks you have some negative development coming out with respect to the US FDA inspections and so on and so forth. It's becoming very hard to navigate the space, to be honest with you. On the one side, you obviously have a fair amount of pressure on generic pricing to start with. And then on top of that, you have the sudden shocks, which we have seen, in case of Cipla a few months back, in case of Sun also a couple of days back. So it's just becoming a bit tricky to navigate the space. So, apart from the domestic pharma story, we do like the healthcare space actually a lot more. Healthcare services part, that is.
Okay, so like the healthcare services a lot better than the policy changes that we have to navigate when it comes to the US FDA issues, etc. as well.
Yeah.
But Sanjeev, what's your take on autos? Because we had seen a solid run in the year gone by. Now we're talking about El Nino. We are talking about how the rural consumption might, fall off this year a tad bit. How should one approach the auto sector? Still positive looking at the valuations?
Oh, no, we are quite negative on the auto sector actually. Barring M&M to some extent, we have pretty much reduced our sell ratings on most of the auto OEMs. Obviously there is some amount of short-term excitement for the run which has happened last year, more to do with commodity price correction and hopes of margin expansion. But if you look at volumes are still very, very muted. Obviously, you have seen a recovery from the COVID-affected lows. But you compare that with FI 18-19 levels, in most cases, volumes are still struggling actually to get back to FI 18-19 levels. So where is the question of, giving higher multiples compared to where the stocks were trading earlier with this kind of a demand environment? I think you will see a lot more earnings downgrades as far as the auto sector is concerned going forward. On top of that, the medium-term story is very, very challenging given all the disruption which is coming through. And I don't think many of the incumbents are fully prepared for it. Somehow they seem to be of the view that EVs are, something which will happen in the next century. I mean, I think it's happening very fast. If you look at the uptake in many other countries, the pace of, EV adoption has been absolutely phenomenal. And I think the same story will repeat in India too.
Sanjeev, I also wanted to understand what your outlook is when it comes to the entire manufacturing theme, because clearly it seems that there is a lot of potential within this space. Is there anything specific that you would look at when it comes to the earnings season within the entire gamut of capital goods, railways, defense, stocks, or even infrastructure as a whole?
So again, it's a very broad-based, thing that you're referring to. You'll have to look at things again on a very bottom-up basis. We do like the manufacturing sector as a theme going forward. But having said that, how many manufacturing stories are available in India? That's our problem. So hopefully, as the supply chains, develop in India for manufacturing more and more components going forward, some of the new technology. As the development starts taking place, you start seeing, more of investment taking place. That's when you can probably start getting more ideas. As of now, when we look at manufacturing, the focus immediately shifts actually to capital companies. That's not really manufacturing. So hopefully over time, given the government thrust on domestic manufacturing, PLI schemes and so on and so forth, you will start seeing more of, actual domestic manufacturing starting to take place for the domestic market and hopefully for exports also. And you will probably get, much better ideas going forward. So as of now, we are playing the manufacturing theme through the, usual suspects in the capital goods space, whether it's ABP, companies, etc. But so they're not really manufacturing companies in the true sense of the word.
Right. But you think, Sanjeev, manufacturing after a period of 13-14 years is finally showing some uptake, some changes. Companies have learned a lot in terms of debt, how to bid, not be very aggressive in acquisitions or acquisitions of land. You think all of this will lead to a small structural recovery for companies that are disciplined?
I think you will see a fairly long-term cycle as far as manufacturing is concerned. I don't dispute that theme at all. In fact, we've been quite positive on this for the last 2.5 years or so. So all that will happen. The question is, what is available in the manufacturing space to play this as of now? One of the worries which I have is a lot of manufacturing could be in the unlisted space, from a public market perspective. If you look at, for example, the whole Apple ecosystem as it develops in the country going forward, it could well remain in the unlisted space, So that's where the challenge will come, Yes, factories will get built, jobs will get created, manufacturing GDP share as a proportion to GDP will increase, and all the good things will happen, which will eventually result in more consumption and so on and so forth. But that's a very indirect benefit as far as the stock market is concerned. I'm not too sure, whether you, at this point in time, have enough of manufacturing place so that you can play directly, or even going forward, you will see interesting manufacturing companies getting listed. And look at China, for example. You have so many manufacturing companies. I mean, you have like at least 3-4 large, very big battery manufacturers. I mean, you don't have anything like that in India at this point in time, and the growth rates are absolutely phenomenal. You look at the numbers for BYD, Kettle, etc. It's like insane numbers, absolutely.
Right. So one, of course, is manufacturing, but second, of course, construction, real estate. Do you think that's also an important part of the GDP, and that's also learned a lesson in terms of how to operate going ahead?
I would agree. If you look at most of the companies, they are clearly deleveraged over the last 3-4 years. The balance sheets have become a lot healthier. And thankfully, the macro tailwinds are there. Again, this is the theme which we are structurally quite positive on. This again could be a multi-year investment cycle. So far, the housing demand seems to be holding up reasonably well, despite increase in interest rates, which we have seen. And if interest rates are peaked, then maybe the cycle could sustain for a longer period of time. It's just a simple story. As India gets richer, and people start moving to cities, we will obviously see more and more, housing demand coming through, which will result in, some of these housing companies doing well over a period of time. So it's a fairly simple story, but just that last 10 years, things haven't really played out the way it was anticipated. But now, if you look at the affordability index, is actually quite favorable. And if the job situation keeps on improving as India does more of manufacturing, outsourcing of services, etc., hopefully this theme will sustain for a longer period of time.
Whether it sustains or not. But Sanjeev, you just talked about the banking earnings in your first answer. I want to deep dive into it a tad bit, because now the street is a bit worried that probably the net interest margins, etc., have peaked, given the fact that the cost of funds are likely to go higher. Do you see that as a big worry for the entire NBFC space, and how should one approach that?
No, I think it's a given that NIMs will compress from the artificially high levels of FY23. I mean, I don't think any analyst or investor really doubts that, So, it's okay. That was something which was unwarranted, the kind of NIMs which we saw in the second half of FY23. So I don't see why that should be a big concern, to be honest with you. It's not as if, you're seeing a sudden collapse in credit growth or, a big NPL cycle looming in front of us. So, NIMs will be lower on a year-on-year basis. Net profit growth will obviously be pretty muted in FY24 versus 23. But having said that, most banks will still deliver fairly high, ROAs in the range of 1.5 to even 2%. Some of the better ones, ROEs seem to be in the range of 12 to 16% for most of the banks now, closer to 15 actually for some of the better quality ones. So you will still see compounding in book, and valuation is very reasonable. Most of the banks are still below 2 times price to book. Leave aside HDFC Bank and ICICI, which are both trading at about 2.4 times March 24 interested book. I just take out the value of all the non-bank subsidiaries associates. All the others are well below 2 times as of now. So decent compounding possibility over here, even if you don't see much of the rating in the multiples.
Any view as far as the consumer durable space is concerned? Today we are seeing reaction, of course, on Crompton Consumer due to the leadership change. But overall for the sector, what's the view?
The demand conditions seem to be fairly muted as of now. I guess it's simply a problem of availability to start with. Obviously, prices in India have gone up a lot across the board for most household goods, etc. If you look at the last 4 years increase, in most cases, prices are up about 6 to 10% CAGR actually, and the 4-year CAGR at about 10% is actually a very big impact as far as prices are concerned. So yes, affordability itself is a big problem. The hope here is that over time, as income levels continue to rise, prices hopefully don't go up much more than they have already gone in the last few years. The affordability situation starts becoming better, and that should hopefully result in demand coming back. Having said that, I don't see this, changing in very swiftly. I think it's probably 2 to 3, probably 4 quarters down the line when we'll start seeing some recovery in demand for discretionary items. I'm a lot more hopeful about consumer staples, simply given the fact that you are seeing job recovery and income recovery as far as low-income households are concerned. And they were forced to cut consumption during those horrible COVID time. So hopefully you'll see a rebound in the consumption patterns of low-income households for consumer staple items. Yeah, and then it's some more of gross margin expansion also. I think the consumer staple names should do better from current levels.
Consumer staples are likely to do better. Thank you, Sanjeev, for joining us today and talking to us about a whole
Pleasure.
host of
Thank you.
sectors.